Stocks overvalued? Some say so, some say not. One way of measuring it is the PE ratio, price to earnings. That measures how many times earnings is the price of the stock. Traditionally, the S&P 500 has stayed in the teens, 15, 20 times earnings. But now it's up over 30 times earnings. PE ratio of over 30 for the average. Now, an average is the middle, therefore there's some that are much less and some that are much more. But a better way of looking at it to say, is it overvalued? Because that's more of an arbitrary number, is to flip those numbers around. Earnings per dollar of price. So instead of PE, it's an EP ratio. When you do that, it's also a very similar number. It's at extreme. But now you can compare it to interest rates. And because interest rates are now at record lows again, it doesn't seem as bad to have, say, a 2% earnings per price when interest rate is zero. Now, 12 years ago in 2008 or even 2000, when interest rates were, let's say, 4%, if you had earnings per price of 2 or 4%, you say that's not very good. You're better off getting 4% and just going buying treasury bonds. But right now, there's still a value in stocks over cash or over treasury bonds. And so in that sense, stocks aren't overvalued simply because their value has gone up, because interest rates have gone down. Therefore, stocks are allowed to and justifiably have higher valuations right now. Something to watch if and when interest rates do rise in the coming years. But for right now, stocks are not overvalued based on their PE ratio. I'm Justin Struble with BSG Advisors. I'm not a broker, I'm a fixer.